According to the Stellenbosch University Bureau for Economic Research, South Africa's inflation is expected to decline for the next 2 years. There are warnings that the decline might not be enough to cut interest rates. The latest survey also revealed that the average inflation for 2024 dropped to 5.4% in the first quarter. Joining us to help make sense of all of this is Elna Moolman, who's the head of SA Macroeconomic Research at Standard Bank. A very good afternoon to you, Elna. Thank you so much for your time. Give us an overview of what this data means. Should we be worried at all?
Good afternoon. So we've received two sets of very critical inflation data over the last 2 days. You've already referred to the inflation expectations data. And then, of course, this morning we also received the latest inflation numbers for February. And these two gives us somewhat different messages. So in February, we saw an increase in inflation to 5.6%, and that was a little bit more than expected. So that is negative, and even if we delve into the detail, the SARB will be concerned about that number. But if we look at the inflation expectations data, then that is actually showing somewhat of an improvement. In other words, a general expectation that inflation would decline over time, and expected inflation is now slightly lower than before. And if the SARB is forward-looking, like they should be, then the latter should be the more important of these two data sources.
Yeah, we know that March was said to be another month which will be facing inflationary pressure because of the massive R1.20 per litre hike in the fuel price that kicked in at the start of this month. What are the other factors that need to be considered ahead of this decision?
Yes. So what is absolutely critical is that the SARB doesn't only focus on the immediate inflation numbers. So you've referred to fuel prices, and of course we're seeing a little bit of volatility there. And the same applies to food prices, which is now starting to become more benign. But over the last few months, it has been somewhat sticky and somewhat volatile, etc. So what's most important for the Reserve Bank is the outlook. And despite this higher than expected inflation data that we received for February, the expectation is still that from here, inflation should generally gradually decline in the next few months, so that before the end of the year, we should still be back around the midpoint of the target range. And that's really what the SARB's focus should be on.
What about the 10.3% month-on-month increase in medical aid premiums? I mean, that was interesting. Generally, consumers are likely to identify with this rise the most. What clues does that data give us about what the MPC committee is likely to do when they meet for the decision?
Yes, so that medical aid inflation number, we should just say that this is surveyed only once a year. So that captures the full increase for the entire year, but it was a little bit higher than we expected. So we expected a bit more than 9%, and like you say, it was more than 10%. So that was then the reason why the overall inflation number was also a little bit higher than expected. And that feeds into what the Reserve Bank calls core inflation. In other words, when we strip out the volatile food and fuel prices. And that core measure is something that they do tend to focus on. So this is a setback. I think we should expect that the SARB will be very hawkish at this next meeting. They'll refer to higher core inflation. They'll refer to the fact that inflation was higher than expected and is edging closer towards the ceiling of its 3.6% target range. So it will sound very hawkish. But to my mind, as long as the SARB's forecasts are still for inflation to generally decline, then we can look forward towards rate cuts sometime later this year.
In their hawkish nature, we know that for South Africa, which takes policy direction from the US, how much considerations will be made there on that scale ahead of the rate cutting cycle?
That is absolutely important. So to my mind, we don't necessarily follow the Fed one-to-one, and we can cut slightly ahead of the Fed. But we typically don't want to be too far out of sync for a number of reasons. One is that we want to have somewhat of an interest rate differential between us and the US, so that investors are attracted to South Africa despite some of the risks and weak outlook and so forth. But the other is also that by the time the Fed starts to cut, or just ahead of that, when it becomes clear that it is about to cut rates, it gives us a very strong signal of what is happening to global inflation. And obviously that filters through into our inflation as well. And so for those two reasons, we're typically roughly in sync with the Fed, not necessarily one-to-one, but our expectation is that the Fed will be able to start cutting rates from around the middle of the year. And so our expectation is then that the SARB can also start to cut probably only from July, because, of course, one of the factors influencing the South African inflation outlook is the election, insofar as it could potentially have an impact on the currency and then on inflation.
In the interim, how should consumers be tightening their belts ahead of July?
I think what will help is that we'll generally see a decline in inflation. If we think about the peak in inflation and how far we've come, yes, there's a little bit of volatility, etc., but just this decline in inflation is already going to provide some relief for consumers. And what I'm also quite optimistic about is the employment recovery that we saw in the second half of last year, both the third and fourth quarter data, and that should also provide a bit of support for the consumer. So for now, there's almost already this built-in inevitable relief. And if we're right that the SARB will start to cut rates, then of course, roughly 1% of interest rate relief will provide further stimulus to the consumer.
Very well. Thank you so much for your time. Let's leave it there for now. Elna Moolman, who's head of SA Macroeconomic Research at Standard Bank, giving us some of the expectations ahead of the announcement on the interest rate.